I'm Steven with LedgerGurus, and in this video I'm going to walk you through our Tariff Impact Calculator, where you can input some key financial information from your e-commerce business, as well as the increased costs from tariffs, to see what the impact of profitability might be. You'll also be able to test what a price increase could do to adjust to said tariffs. So let's dive into the calculator and take a look and see what it tells us.
So here we have the Tariff Impact Calculator, and you will be able to input some data and get some analysis on what would happen. I'm going to walk through the worksheets. There's really one main worksheet where you'll input data. That's the dollar values. There is a calculation worksheet, the income ratios, and there's two definition worksheets. So you will input the values in the yellow fields. And what you'll want to do is put values for the last 12 months of your e-commerce business. Let's walk through the definitions so it's clear what you want to input here. The first value is your revenue. This is your revenue after discounts, returns, refunds, etc. The customs value is what is used to calculate a tariff. This is your costs, product costs, insurance, and international freight. Now, most people don't break this down in a profit and loss. So you can estimate this. Worst case, you could just use your product cost of goods sold, because other cost of goods sold typically is quite small. This is usually the cost of bringing the product from port to warehouse, maybe additional packaging fees or anything that's bought in a non-tariff basis. The increased tariff cost will be calculated, and total cost will be the value of those three items. Gross profit is revenue minus cost of goods sold. Now do note, best practice for cost of goods sold is your product cost, your landed product costs. A lot of people will put sales expenses into cost of goods sold. That is not technically accurate. So you want to put that out in a separate area. Your sales expenses are going to be things like your merchant fees, fulfillment. It could include advertising. If you're so inclined, some people will consider that a variable sales cost. Some people will not. I like to in a lot of cases. Every other expense is non-sales expenses, your payroll, rent, software subscriptions, other marketing. Total expenses is the sum of those two expenses, and your net operating income is your gross margin minus total expenses. Other income and expenses is things like interest income, interest expense. A lot of people don't always put that down in that section of the profit and loss, although that is the best place to put it. And finally, your net income is your final profit or loss after all expenses, including other income and expenses. So you'll want to go grab those values from your profit and loss and put them in. Now, scenario one is going to look at the impact of the tariff without a price increase. You will simply change cell D3 to see what the impact will be. 10% is what we're seeing in China. That can change. So 25% is a number that's being tossed around. You can put that number in and see what the impact is going to be. If you have multiple tariffs, then use your best judgment for creating an average of or weighted value of what that percentage would be. And you can see here, this will calculate down the line what my profitability impact is going to be. If I wanted to see that in a ratio, a percentage of income, I can go over to the income ratios worksheet and I will see that ratio impact. So in this scenario, we lose about 1.7% of our profitability from a 10% increased tariff rate. Now, scenario 2 and 3 will require two other values to be input. Actually, 1 and 2. Scenario 2 is hard-coded a price elasticity of demand of -1. Now, this is a very important concept. It is the concept that if you increase prices, your demand will decrease. And this is a common economics principle. Most consumer goods are going to be elastic, meaning that demand will diminish as prices increase. I have some general guidance here. You can price test to get your actual elasticity, or you can use general guidance. -1 is somewhat neutral, meaning that you will see a decrease in demand, but the price increase will offset that. And so you'll see here that we are using a price elasticity of -1, and the revenue is somewhat flat, almost neutral. And you see a calculation, and we have a better profitability from a -1 price elasticity demand. Now, in order to calculate this scenario 2 and 3, you're going to have to put an order count. You can pull this out of Shopify and Amazon or a combination. And this is a rough calculation of total orders, total revenue, coming up with an average order value, and then decreasing the quantity of orders and applying that average order value accordingly to come up with the impact. Now, 5 is where you get to make some judgment. You can put in whatever price elasticity of demand you want to. And again, going back to the definition, a more elastic product, meaning that you're going to see a higher result of change, will have a lower number. And the way this works is like with a -2, if I increase my prices by 2%, I will see a -4% decrease in demand. And that's what's going to go through this scenario. So we'll see what's happened. You can play around with a couple numbers to see. And again, we can look at the income ratios to see what's going to happen. So this is not designed to be a perfect guide. This is designed to be something you can put some numbers in and come up with some potential outcomes and plan accordingly. So go ahead, play around with the numbers and see what they tell you.
If you need to download a copy of the Tariff Impact Calculator, go to the description where you'll find a link to download it. Also, if you'd like to work with us, go to the description where you'll find a link where you can contact us. Finally, if you found this video helpful, please like it, share it, ask me a question in the comments, and subscribe to our channel for more content like this.